You all right over there? Oh, you want to see it? Man, inflation's so bad it cost me an hour this weekend. All right. That wasn't bad. Yeah. I got another one for you. No. Say it out loud. All right. Let's roll, man. Hey, welcome to the Closing Beat, everybody. Happy Monday. How you doing out there? Hope all is good. We're financial advisors, a little bit offbeat. We get that. Not everybody's going to take us seriously, but I hope you learn from us because we like to teach. We're one of the, I won't say the only advisors. There's a lot of advisors that actually try to teach. These days, that's important, but we enjoy it. I like sharing stats with you. I like looking at the market every day. We like doing some office trades with you. I'll cover that in a little bit. I like to teach you stuff to help get your dough straight because over the weekend, I was, let me say it this way. So over the weekend, I was talking to a neighbor. He's kind of like around the corner, and we had a little gathering there of all the neighbors. And he was an older guy. He's retired, but he doesn't look older, right? He's very much, you'd say he's in his 50s. So I thought he was in his 50s, and he's retired. So I was like, hey, man, something to share with my people. You know, like what do you think that the definition of wealth is, right? Since you obviously are retired, hanging out, having a good time, and don't know if you have millions of dollars or hundreds of thousands, but what do you think wealth is? And he had a little bit to drink, I'll be honest. It was a bourbon tasting party is what they had over there. So he said, the definition of wealth is not, defined by money anymore. It's actually defined by what you can and can't say. And he said people that are not wealthy in their own right would think to themselves something funny, a joke or something they want to share with somebody, and they might go, I don't know if I should say that out loud. I'm probably not allowed to say that. Whereas someone that's wealthy would think of that thing and go find somebody to tell, and their brain would say, I don't know, maybe we shouldn't say that. But then it gets overridden, and their brain says, let's say it anyways and see what happens. And then, he got a laugh out of that, and I'm like, okay. So the definition of wealthy is being able to speak freely. He said, to some extent, right? We don't want to offend people, but I thought that was funny. Anyways, welcome to our show here today. There's a lot going on in the stock market, and there's going to be a lot going on this week, man. We've got a whole lot going on as far as the economic news coming out, the Fed, the stock market, those people in Russia doing whatever they're doing in Ukraine. You got China in the mix as well. Two main market movers here today were both China and the Ukraine, Russia/Ukraine thing there. China basically shuts down Shenzhen, which is a large tech area. And I saw the media caught that real quick. It's a big tech area. This could be a problem for us. Start bleeding into some of our tech going forward. Semiconductors, a lot of software over there and stuff. But I don't know if you know, but it's also the second largest and the third busiest ports in all of the world right there, shut down for 7 days. And so that's going to trickle over to us, which is kind of a big deal. It's shut down for 7 days there, which, obviously could stress things already. The good news is that when you have higher gas prices, the consumer, you can see it. Once we get the data, we'll share it with you. But when gas prices sustain themselves higher, the consumer shifts from products to services. So a little stock tip for you there if you're thinking about that. If we keep gas prices high, the consumer's not necessarily interested in buying physical stuff. They move over to services. It's a known sort of economic shift that that you can actually quantify. So that was that. And then as for Russia, maybe talks of a ceasefire or some progress being made over there, maybe help the price of oil fall a little bit, and the China thing as well. Which I think if there's even a temporary ceasefire or there's some progress in negotiations, I think that's pretty smart on Russia's part because you can look at every form of data. I shared with you last week all the losses that Russia's taken and all their different artillery. They could use that time to rebuild, right? Reload, sort of their front lines are beaten down a little bit there. So I don't know that I trust that as a good thing if Russia takes a little pause on what they're doing over there. But I'm not a world expert there, so I just throwing in my thoughts in that case. If we look at the S&P here, down, let's go look. S&P down on the day, was up overnight. And that's always interesting to me because when the S&P is up substantially overnight, as it was, you go, what happened? What's the news? Why is everybody excited? And there wasn't any. Unless you're a big fan of Tom Brady coming back to the Bucs and all that, then okay, that was it. But that was the only news. And it's not like that washed away all the other news. There was just nothing going on. So you always want to be suspect when you see the S&P higher overnight, and you can't attribute it to anything, right? Oil was down a little bit, but no real geopolitical news that was positive. I mean, rumblings of this and that, but nothing that would move the market. So I was a little suspect last night. I mentioned that in our office trades here today, it's a little bit different there. Now, if we look, as of Friday, we had about a 12% decline, just over 12%. And that's where we stand right now, just over 12% off of highs, which would be over here. That is the 21st decline since the financial crisis that is greater than average. I'll show you. So you always look at things like this. What we have here is every pullback from highs, the extent of every pullback from highs. And if you look back, you've got an average of 9.61%. We are now down just about 13%. We closed a little bit higher than that, but just about 13%. And right now seems like kind of an uncertain time, right? A lot of weird talks out there, a lot of things happening there. But in reality, there's been countless times in the past where you're like, I don't know, this is it. This could be a problem. You know, these things come and go. One negative thing, well, first of all, I want to point out, you've got this decline that's more than average, right? So the first thing you do when this happens is you go, okay, greater than average decline. What are all the economic indicators showing me? In other words, do we have a higher VIX? Do we have put-call ratios that are going crazy there? Do we have advanced decline lines that are crazy as well? Bearish sentiment's a good one. The AAII does that survey if you want to look it up. You go, well, is that looking extreme, right? So is this bad or could it get worse? Well, right now we have our 13% decline here. And the VIX, put-call ratios, AD lines, and all that stuff are not as bad compared to every other time that we've seen a decline. Is that good news or bad news? So if the overall economic indicators that we use and economic sentiment, if it's not at extremes, then it may lead you to think that there's room for that to become extreme, which would push the market down even further. The VIX currently ranks as the 6th worst since the financial crisis. So that's not extreme at all, certainly high. The put-call ratio would be the 10th worst out of all of the other 20 scenarios leading back to the financial crisis. The bearish sentiment is the only one, I think I shared this with you at some point, the bearish sentiment currently is the only one that is in second place, right? Meaning 2009 was the only other time that survey generated more bearish sentiment than right now. So that's pretty bad right there, that if you're looking for something there. Now, all this to say that what we have here is bad, but it could certainly get a whole lot worse because we don't have those extremes and all those indicators that people like to look at. And so what happens? If we fall from here, we all have our eyes on 20%, right? Let's see if that happens, right? Where I was going with this, if the market does get a little bit worse from here, we're looking at 20%. Let's take a look at what the market tends to do when that happens. So I'm going to go over here. Here's the average performance after hitting a bear market. Down 20% from highs is considered a bear market. So if we look out forward, you have 1 week performance basically flat, 1 month performance basically flat. It takes about 3 months to start seeing the stock market come off lows. That doesn't mean that it's positive 2%. That means that we hit 20%, we could fall another 10, but 3 months later, we've bounced 2%. Right? 6 months later, we've bounced 4%, and a year later, 8%. So bear markets are welcome, but in the short term, they're going to be rather painful. As for the probability of being positive over those time periods, over 1 week, you got about a 50-50 shot that the stock market's going to be positive after it hits a bear market. I'm just hitting you with this data ahead of time so you have it. 60% 1 month later, and we really don't start creeping up, and it's not even that much, until 3, 6, and 1 year later. 1 year later, you got basically a 70% chance that if you bought the bear market, you would then have some sort of positive gain. 6 months later, 66% chance, which is, hey, still better than 50-50, right? 63% after 3 months. So just something to show you there as a different way to look at it if the market is headed for a more of a pullback here if we get to that 20%. So we got about 7% left to go, which in this current world right now, 7%, you know, it's like, that's not much. We could certainly take care of that in about a week. Anyways, if you look at the S&P here today, the trouble was You couldn't get the big guys moving. We talked about this on Thursday as well. That was the trouble with Thursday's market. Microsoft couldn't get anything going. Apple's in a little bit of trouble here because of how Shenzhen's going over there. Foxconn also decided that they're going to, I'll cover that in a minute, but they're going to be halting production and maybe even stopping that plant. I think the latest news was they're going to stop production, building in the plant over there. You got Google down on the day. Amazon also starting to bleed a little bit lower. Tesla couldn't get anything done here today. And so add that to the semiconductors that were already weak because of what's going on in China, and you have room for more weakness. NVIDIA, Intel, all real weakness here. There you go. Come on down. Qualcomm. These are all starting to get to be extreme sort of pullbacks there. This also bled into other categories that are software related, like Salesforce.com. Intuit's going to be one of them as well. A little bit of production out of Shenzhen from Intuit and Salesforce, things like that. Applied Materials also selling off. And remember, where tech and semiconductors go, so goes the market. So those are showing you the signs right now that they are just a little bit weak. As far as the NASDAQ, that's the weakest out of all of them. Wait, one more thing. Go back to the S&P. The really, really bad thing about what happened today, and if it doesn't find itself higher very quickly, is a problem, because we did not even meet our downtrend. A stock market can have a really nice downtrend and it would be welcome. You guys would all say, great, give me those ebbs and flows so that I can add more money and take profits or whatever you want to do. Well, normally a downtrend would be very uniform and intact. What we have now is a downtrend that's accelerating. So it's good news, meaning when something accelerates, like the price of oil, it doesn't last very long, but it can be painful, like the price of oil. So with the S&P here, we have a very clean and clear defined downtrend, but we've yet to even come back and try to make this look pretty, like a nice downtrend. That's not a good sign there. Normally you would see that different. With the Fed announcement, usually the Fed raising rates is positive for stocks. And given that we already know that, maybe that's going to be the case. The NASDAQ lower on the day, that's going to be because of all those names I just mentioned to you there. The Russell was the weakest out of all of them, but it's just slopping around. There's no good news there. I got nothing to share with you. Oil continued to pull back and stopped right at $100 a barrel before bouncing a little bit. Now, that was lower today on the double whammy. We got China and you got the Ukraine. So you got China shutting down over there. What's that mean? Well, if China shuts down, what does it have to do with oil? It means there's probably going to be less demand. Less demand means lower prices, right? If you look at the Ukraine-Russia thing, that's obviously been moving oil for quite a while. What are we going to do, on the side of Russia? Are we now just going to Argentina to buy our oil, which is essentially Russia anyways? And so there's a lot of concern there and causing more volatility. So that sticks out, and that was probably what was really jostling around oil here today. The excitement, if you're looking to be a dip buyer, is over in consumer staples. I don't know that it's just yet. They tried today. Some did better than others, but consumer staples at the moment offers the most amount of extended stocks. So if you're one of these people, you see that chart and you go, hey, if it falls and it gets extended, I like those severe discounts. You're going to be looking around in that sector. You got General Mills today, tried to bounce, couldn't get it done. Maybe that pulls it a little bit further, but you can see how extended it is. Colgate was one we talked in office trades here today. Also rolling over, starting to get more extended. These are ideas for you. I put on a watch list. Kimberly-Clark is already extended. It did the best out of the group here today, but that's also a consumer staple. And Procter & Gamble, right? Normally, these are like snoozers of stocks. You wouldn't want to trade them. If you invest in them, you don't expect to make a profit like the next day. It's going to take a little bit of time. But this area right here, that sector would probably be the area I would focus on the most if you're looking to add positions there. Okay, I got something for you. I got this question a lot. I've been getting the question about Amazon's stock split. Is it a buy? Is it a sell? What are the stats? What do we do? So we got some for you. I'll be brief. We'll go right through it here and let's just see what we've got. Here are the following tickers. We went back 5 years. We'll take a look at all of these tickers that had done stock splits to one degree or another. Not always, 2 for 1 and et cetera. Some of them were some kind of ratio there. But let's take a look. We take all those tickers and we go, let's run some data and let's see how well they do without including Amazon for the second part of what I'm going to share with you. First up, if we look at the performance around the announcement, here's what we're doing. From the time they announce that they're going to do the split, the next day, which we've already passed for Amazon, and Amazon had a positive day as well, the next day averages a 2.3% gain. From the time they make their announcement to the time they physically split the stock, the average gain is positive, 4.44%. Now, all that's kind of already happened, right? We can take Amazon and factor it in here, but we can't factor it in here yet because the stock hasn't split. So now taking all those other stocks that we just shared there with you, let's look at the performance after a split. So the average performance a week later when they physically split the stock, right? So on the night that it splits, usually over the weekend, when we started that next week, you got a loss of 1.6%. From there, it gets a little bit better. 1 month, 2.5%, 3 months, 4%, 6 months, 10%. So what that tells you is if you are someone who looks at a stock split and feels opportunity or thinks you see opportunity, it's likely a 6-month opportunity. Your greatest probability of having the greatest profit is within 6 months. Other than that, you might be better off looking at other stuff or not taking that gamble. So I thought that'd be fun. Something else to look at, huh? All right, as far as our office trades here today, really good one. So if you're not familiar with us, jazzwealth.com/research. If you're not a client, you can join. It's $13 a month, and all proceeds are about to start going to supporting Drum Corps International. It's something that I truly believe in. It just hasn't been the season, so I haven't mentioned it. Now season's starting to pick up for them. So I really love supporting that. We don't obviously take $13 from you and buy lunch or whatever. We're not trying to make money off of it. It goes to a good cause, and we like supporting them. But you can join if you're not a client. If you're a client, it's free. You won't actually need to pay for it. Well, one of the things that's come up is we've just been plugging along, doing our thing, and all of a sudden, we have Las Vegas Sands as a real trouble position. Our position is in real trouble. And so we were talking today about how do you play defense? What can we do? And so essentially, we worked this trade today to show how you can take literally zero more risk, right? No more directional risk than we currently had, but improve our total premium that we've collected and improve our probability of success. So that was really the focus on this one. And Las Vegas Sands didn't try to bounce at all, which is fine. Now we know where we stand with this position. We know exactly what we can do. So if you want to check that out, those are all archived and everything's saved for you in there. That was the bulk of what I did today. However, we did have to put on more short of a position to bring our total portfolio within where we want it to be. And so I did sell the 435 calls on the S&P. Well, the SPY was the particular vehicle that we used there, and used that to try to balance out some of what we got. All right, whoops, I hit the wrong button. No problem. Those things happen. Anyways, yeah, regroup. Let's figure this out. All right. New highs and lows. There were 10 new highs, 30 new lows. Yep, that's what the numbers say over there. EA Sports getting extended, also selling off here. You're starting to look for those, right? If the stock market rolls over, you're looking for stocks that have also rolled over, maybe to the extreme. EA Sports hits a new low and is one of those that's rolling over. Same with Estee Lauder. We actually had a great run with this in one of our portfolios and really scaled back this position before the end of the year and did not know all this was going to happen. Just got lucky there, I guess. And so down another 5% today. All that to say, hey, look, that's starting to get extended as well, is it not? And maybe could get worse, so that one goes on a watch list. Lam Research, and really a lot of the semiconductors, you're starting to see this. This one just happens to be a little bit weaker than the others, so I put that on the list. Travelers for a breakout to new highs is exactly what it is. They have no interest in what the stock market's doing. Think about that. If you're an investor and you own Lam Research and you own Travelers, and you've got an extra $100 or whatever you have in your account, you want to invest it in something, do you want to pick the stock that's performing worse than the market or worse than the industry even? Or do you want to pick the one that clearly is not even paying attention to what's going on in the world, in the stock market, in the economy, nothing? It's just like, I'm going to new highs. Take it or leave it. That's where I'm at. So I point that one out to you. Cincinnati Financial, also in the regional bank space, this one really hasn't participated much either. Though it did pull back a little bit, but nothing like the market or the industry itself. Here's the KRE, which is the regional banks ETF you can look at. More of a pullback there. You look inside and you go, well, which ones haven't participated as much? Cincinnati Financial, and I think today is one of those reasons you see analysts upgrading it, recognizing the strength, recognizing the opportunity, but also other investors that say, I've got to have a regional bank. I want to put something in there. What do? You go pick on the stocks that aren't giving you as much grief as everything else. And maybe Bristol Myers. Here, I'll throw a little final one in there. So Bristol Myers, see that? You got a series of highs. It did touch new highs today. It did fade at the end of the day, but that one is hinting as well that it doesn't want to participate with the market. It's just moving along, a very, very tight, consistent uptrend. Very cool. All right, stocks in the news here today. Apple. Foxconn did say, well, everything else continues, but they're stopping production in the Shenzhen plants because they have to. 7 days they've got to shut down. That hurts Apple there. So that was, in fact, in the news. Ford. They're going to, if you're buying a new Ford, it might be missing some chips, some semiconductor chips, but they're like, hey, just take the car or truck and then give us about a year, come back, and then we'll put the chip in there. So that's their plan. That's where we're at. That's what people have to do to keep moving this product. Occidental Petroleum. This is the Buffett bounce right in here. So Occidental Petroleum, we find out that they've added another 27 million shares to their position. They are quite bullish on Occidental Petroleum. Good for them. Uber and Lyft, actually, are going to start charging a little bit extra gas surcharges. I read somewhere between 35 and 55 cents for that. So that makes sense. They had to do it at some point. Can't sustain that. Yum China. Well, you can see that's a tough one there. Yum China says they are going to be and are currently significantly impacted by the latest outbreaks there. Thursday, I mentioned some of the case counts around the world starting to rise, the 7-day average case counts, and that kind of made it into the news over the weekend there. No bueno, right? That's not good. Not good. So you've got Nikola, and this is a tough place to be for some of these guys. Nikola's down 8%. So Nikola needs to sell another 200 million shares. They only have 600 million out there. So they want to go from 600 million to 800 million by selling you 200 million more shares. What does that mean? They're diluting the price of the stock. They're diluting your ownership, essentially, to raise more money because they have to. When you start looking at Rivian, they didn't plan for the commodity increases here. That's unfortunate, right? So now they're having to raise prices on vehicles that they haven't even delivered yet. Got some real problems there. So in that space, I wouldn't want to be there. Let's just put it that way. I wouldn't want anything to do with that. Okay, what else do we have here? There's an industrial news conference tomorrow, or an industrial conference. JP Morgan puts it on, I believe. That is tomorrow. So the JP Morgan Industrials Conference starts tomorrow. That could move some stocks in that sector. It's not quite as crazy as the healthcare conferences that they have. And there is one tomorrow. It's like Barclays or something. But it doesn't tend to move stocks like the JP Morgan Healthcare Conference. Anyways, they're doing one for industrials. And so other than that, you just have Dole reporting earnings, and that's about all I have for you. I will answer your questions if I can, and then I will get out of your way, because that phone call was to tell me that my truck is ready. Had some work done on the old 1941, and I'm excited to get it. Nikola's still in business. Yeah, they're still in business, doing their thing, man. That's interesting. Rivian, same thing. Same thing. Wish them well, though, because apparently Washington says we all just have to go buy electric cars. Don't like the gas prices? Just go get yourself an electric car. Sure. Yeah. I like it. Andrew likes your SoFi. Do you now? You like the cheap, the discount there? I like what they're doing as a company. It has not reflected in the stock price. That's like DraftKings, right? DraftKings, hasn't reflected yet in the stock price, but it will. They're doing the right thing there. They at least can get a path towards making money. Our own government, Washington, tried to do gambling, and they lost money, our money. They got it. He was wrong about China stocks. Ooh, I saw Alibaba today. Yeah. Yep, $77, and that likely has a little bit more volatility there because of what's going on. But now the cool part about it is if you liked it at 100, now you can let it bounce around and see if it's actually going to start going up, and then just buy it at 100, right? Think about all the people that you guys were saying, $100 sounds attractive. Okay, you can still have it at 100, but now you don't have to try to guess the bottom at 100. So it's a different way of looking at it, but I hope that's soon for you. Oil, will it be stable or booming long term, 4 or 5 years? It's going to be incredibly volatile for the rest of the year. So after that, I think you look at it and say, well, where'd we land? It's just a guess right now. That's why I'm a financial advisor. Well, yeah, financial advisor is usually not the term, I guess, but. Timothy Rogers, Cinnamon Toast Crunch or Honey Bunches of Oats? I actually can't have Cinnamon Toast Crunch. Fun fact, for a while there, this was years ago, I was having this throbbing here. It didn't hurt. It was just like, wow, that's different. And they did all these tests on me and everything, like making sure I wasn't going to like stroke out or something. And everything was clean, clear, healthy as a horse, all that stuff. We don't know. So they put this pack on me and I had to wear it for like 3 days. And we were trying to figure out what was causing the Cinnamon Toast Crunch. Something in Cinnamon Toast Crunch, which I would eat religiously back then when I was younger. I can't have it, man. And so otherwise, CTC beats the Honey Bunches hands down if I could have it. No, you guys with the Honey Bunches, what are you doing? They had a good commercial for a while with that lady working in the factory. She was funny. Yeah. You got positive news on gold? You mean GOLD, the ticker symbol, or the commodity? Because I think what you're probably talking about is the commodity. If you're looking for it to pull back, that's your positive news there. No way you try to buy this after such an extended move. There's a rule. After a stock goes parabolic, climactic, or whatever you want to call it, after a stock goes parabolic like this, or a commodity index or whatever, you never try to buy the first pullback. That's always a fake out. Right? And even if it's not, you'll notice that the profit is just so small. You'd have to be so quick to make any money on that first buy. So never buy a stock the first pullback after going parabolic. Yep. What do you think about the geopolitical problem with China and the U.S.? Do you think there'll be a war? I don't know enough about it. I honestly don't know enough about it there. If there's something that bad going on out there, I think the markets would have already responded, and I'd have had to look it up. But I don't know. I worry about the added confidence over there, but see what happens. Yep. How can you get more gains on 1 share of Tesla or 100 shares of SoFi? We need them to go up, right? So I would say you would likely see, and I don't know that they bounce from here, so I'm just basing this on volatility. What would be more volatile for you? Unless SoFi has every analyst upgrade them all in one day, I think Tesla could still be a bigger mover in one good day versus SoFi. So that's not to say go buy Tesla. I'm just saying that's, light years more volatile than SoFi at the moment. Yeah. Yeah. Peanut butter in your cereal. What's wrong with you guys? Peanut butter. Where are you putting cereal? Look, cereal is for sugar. That's all it is, right? We don't put other stuff in your cereal. Just leave the peanut butter out, the chocolate and all that stuff. You put sugar in cereal. Whatever cereal has a lot of sugar and none of the other nonsense. Those are the ones that are good for you, right? Just keep that in mind. That's the life lesson for the day. How long you think stocks will be down for? I worry about them falling a little bit. Yeah, you especially after today. I kind of alluded to that earlier with why can't we just go up and test the downtrend? It's okay that we want to keep the downtrend going, but we can't find enough strength just to go up and test the downtrend? That bothers me. So I think we've got a little prolonged weakness here. Also, with the Fed coming up, it's not likely to see a really, really big move one way or the other unless there's a major change in the war that's going on. Yeah. Yeah. The reason behind China's port closure is the COVID shutdowns. They have a zero tolerance rule over there. Any sign of COVID, they just shut it down. Quarantine. Okay, I'm going to wrap it up there and be on my way. I appreciate you guys watching. Have a great rest of your day, and we'll be back tomorrow to do it all over again. Adios.